This Saturday, get ready for 4 game-changing webinars that could transform your money, mindset and future. 10 a.m. we have 1 crore lump sum strategy webinar. Ria had savings but kept waiting for the right time to invest. One decision could have fast-tracked her to 1 crore, but she missed out. Don't make the same mistake. Learn how a one-time investment can take you to 1 crore faster. Join us on this webinar. 11 a.m. we have Knowing Your Potential. Arjun always thought wealth was just for the lucky ones until he discovered the key engines of financial success. What if you are sitting on untapped potential? Unlock the secrets to accelerating your wealth. Register now. At 11 a.m. we have another webinar, The Future of Fashion, Thrifting and Rentals. Indian weddings mean lavish spending, but Gen Z is rewriting the rules. Sustainable budget-friendly fashion is taking over. Are you ready for the shift? Register for this webinar. At 12 p.m. we have Secret Budgeting and Investing Hacks. Neha earned well, but had nothing left at the end of the month. Then she found the formula to make her money work for her. And you can too. Master smart money management and make every rupee count. Don't miss this. And this webinar is exclusive for women. 4 power packed sessions, 1 unmissable Saturday. Limited seats, so register now.
So there is no connect to the investor's potential and is investing. That is my major problem with index investing. I believe that if you don't want index investing, at least come to the value school and find a few good people. At least stay there. Don't restrict yourself to something which is so suboptimal and I would think qualitatively pathetic. Because I will tell you, in Nifty, I am unable to buy 40% of the stocks on governance and another 20% of the stocks on valuation. If you cannot invest in 60% of the companies, how will you invest in the balance 40 to meet your investment expectations? I mean, whereas in a good active portfolio, I may have disagreement on 20% or 30%, not 60%.
Correct.
And in an exceptionally good portfolio, my disagreement comes down, tends to come down. I may say, okay, he's holding this, it is expensive, let him hold, let's see what he does.
Correct.
Maybe he'll buy it if it comes down.
True.
Right? So, when you have a qualitative disagreement of such a high order in the index, I cannot come around to buying it. It's a pure investment merit that I am talking about. And the only thing that we are countering this is with cost. The only argument that stands on its feet is cost. It's like buying a knife which is made with the right steel at a slightly expensive price from a very reliable brand you like, or going in for a Chinese knife which is priced cheaper. I would any day buy the better knife because the job is to cut.
True.
And you should do a perfect job of cutting. People are picking Chinese knives. Index, in my opinion, is like a Chinese knife, a cheap Chinese knife, which is bought purely on price. Now to the next one. I am going into the next thing. That is dynamic asset allocation versus indexing. And I am going to let you start.
Any fund in India, any investment which you are making for a long term, you have to consider taxation as of today, which actually doesn't make sense because 20 years later who will be in government, what will be taxed, we have no clue. But we are hoping after the Vodafone case that there will be no backdated changes, no retrospective changes saying from, so let us say some changes happen in 2029 or 2030, it will only be for the future and not for the past. On that basis, I can't today invest in debt funds because any withdrawal any time from the debt fund will be taxed as my regular income, not as capital gain, or even if it is treated as capital gain, it is going to be added to my income. So that it becomes very inefficient. So therefore, a fund which dynamically allocates between equity and debt, and maybe even between types of equity and debt, I am very comfortable because I will pay tax only when I withdraw. So in the interim, whatever he does or she does as a fund manager, I still get value because after that I am going to pay equity taxation. That is
Also, the dividend taxes are very high if you are.
correct. So if I especially if I do value investing, if I buy NTPC today and get an 8% dividend yield, I lose 30% at least. Maybe I lose 35% on taxation. So that 8% is no longer attractive. It becomes 5.5% for compounding purposes. So I'd rather be in a growth option in a value fund which has a lot of these dividend yield kind of shares in dynamic asset allocation, because the fund manager can decide when to move into equity, into long-term equity or short-term equity, and which quality of equity to buy. So I would rather put money in a dynamic asset allocator, but you have to remember a bull run makes a dynamic asset allocator or a balance advantage fund look great, but that is because the equity has done well. So our expectation from balance advantage fund also has to go down, treating it like an equity fund as far as expectation is concerned. But I think the safety of having some debt, which the fund manager will choose the allocation. He has a lever of how much of equity and how much of debt. During markets like this, which I think are which are highly priced, which are priced pretty high, you can have more in debt and less in equity. Slowly, when the market improves, you can move from debt to equity, or you transfer systematically and you buy. I mean, you get shares at 8% dividend yield. It's better than debt.
Within dynamic asset allocation, the argument is that there is too much trading. What are your thoughts on that?
I think I will leave it to the fund manager's choice. I may not like to trade, but after giving him the money, I'm going to only judge him by results. If there is too much of trading, obviously the transaction costs will hurt me. But if my returns are good, I won't get too much into his style and things like that. Maybe some money I may remove, saying, oh, this is little risky. But I wouldn't worry too much about. See, you can't worry too much about everything that a fund manager does. Ultimately, if he is getting me good results by whatever he is doing, I have to accept that what he is doing is right.
Are you saying that the investor needs to be less judgmental or listen to less judgmental people?
Investors should take a lot of time in finding a good advisor. After that, you should listen only to that advisor. If he gets anything, just send it to the advisor and then let the advisor decide whether he should even see it or read it or whatever.
While on the subject of advisor, I am going to talk about something I observed a lot. As an investor, I am myself a highly judgmental investor. But when I wear the advisor hat and evaluate a product, actually I must put myself in the shoe of the manager and start thinking.
Absolutely.
I cannot think from
Absolutely.
my perspective as an investor.
Absolutely.
When I evaluate any portfolio, Subra, suppose you tomorrow say, Shyam, look at my portfolio and tell me. I'll first look at what is Subra investing for? Who is he investing for? What is the composition of the portfolio? Is this composition matching that person?
True.
Is the style of investing matching that person? Is the
True.
churn matching that person?
True.
Is the dividend yield matching
Correct.
the risk profile of that person?
Correct.
And is the structure of the portfolio, the weightage of individual stocks, matching the return expectation and the risk profile of that person? So it's not the fund alone that you evaluate. The element of suitability comes in.
True.
So we have a method of having suitability for every investor actually. So when you look at the whole universe of funds, to me the product should suit a large number of people.
Correct.
Acceptability.
Correct.
Today the most popular funds are popular not for performance. Yeah, people have chased it for performance. But they will be sustainably popular only on the plank of suitability. That's right, that's what I feel. So you may have two funds which have performed very well in 2023. Okay. One did not perform in 2024. The other continued to perform or did much better than peers, benchmark, lost less. This difference between the guy who performed and the guy who didn't perform clearly is suitability. So when you evaluate the portfolio, when I evaluate the portfolio, I look at the portfolio, I look at the core issues that I need to look at and not what is aesthetic to me as an investor. Now, he may build a portfolio very different from what I build. That is his aesthetic.
Correct.
But I am willing to accept that aesthetic if it suits the investor.
True.
Right? And I have always found the best active funds have far superior aesthetic than their benchmark, irrespective of which benchmark they are chasing. I have always found benchmarks lacking in the investment aesthetics or not suitable enough for the investor. But there is a tacit assumption in our society that the benchmark's aesthetics risk profile is perfectly suitable to the investor. You assume, you give it.
Perfectly suitable to all the investors, which cannot happen. It's not one size fits all.
So, we are again going back to where I started this point. Does a product suit a large number of investors is what I said I look at.
So,
And I found that if I got this fit right, I have not gone wrong in my advice. That's the thumb
so
rule.
let's put it this way. In English, we say getting into the other person's shoes.
Correct, empathetic.
Right. Now look at it physically. To get into my shoes, the first thing you have to do is to remove your shoes.
Correct.
You cannot get into my shoes wearing your shoes, which many people do. So that is where the question comes as to, why asset allocation is so difficult is because asset allocation has to be done by the investor with help only from the financial planner. It cannot be from the fund manager. Fund manager does not know the client. So when the fund manager goes and says this is a time to be in VAF, he has no clue whether my client is 80% in equity or 80% in debt. For both those clients, BAF is not suitable. If the only product I have is BAF is suitable. But if I'm already 80% in equity, I need 20% to be in debt. I can't put that 20% also in BAF. I'm increasing the risk, right? So asset allocation is something which the investor and the advisor sit together and decide, and tactically you may move out to meet some short-term goals. So my view on your long term is based on many things, based on your job, based on your wife's job, based on your inheritance and all that. I base on all that and decide your asset allocation. After I have done asset allocation, we stick to that, and some tactical asset allocation can happen, daughter's college to be funded, etc. You can say, okay, this much money is not part of the portfolio. I've already set it apart from expenses. After that, your asset allocation continues as it is, and then the change happens only when lifestyle changes happen in the client's life. He loses his job, or he leaves his job and takes up a business, which means his whole life becomes equity. Earlier he was working somewhere, now he has to reduce the risk, right? So all these things have to happen. So asset allocation is dynamic. It can be done only by the investor and only with some decent help from the advisor. This is how it has to happen, and the fund manager has no role to play here. But fund managers come and say, oh, this is a good time to be investing in BAF or multi-asset, etc. And actually they create noise which hurts the advisor, actually hurts the advisor.
There is one thing that I have never done, which is ask the manufacturer which is his best product. It's very interesting. My observation is that most manufacturers don't know their best product. I've been 15, 16 years in this industry as a very close watcher. Earlier I'm more a spectator. But my role in the last 16 years has been quite strong and very focused on what people are doing. Anyone asks me for an opinion on a product, even which I don't invest in, I will go through it and only give the opinion. I won't give a superfluous opinion, oh that guy, don't do that. I look at the portfolio and then decide whether that product suits my investor or whether my investor needs to take some action on that. So when I look at the product, I get an evaluation of what that looks like. When I talk to the CEO of the same fund or any person from the sell side, including the manager, they would always tell me it is doing well. That is the first argument. Whereas I would look at whether it will start doing badly. The fact that it has done well is a given. I am not taking it away.
Visible in the numbers.
Yeah, it's a given. Like if somebody followed a momentum approach and it worked very well, I readily concede that success and recognize it. But I am looking at whether it can fail.
Correct.
And I am telling the client, yeah, it did well, kudos. Now time to go to safety. The manufacturer has never told me in any product that you need to go to safety. Never. Nobody from the manufacturing side.
Correct.
You are not going to get an idea about what you need to do. The irony is that the influencer also comes from the same DNA, interestingly. I'll tell you why. The influencer also is looking at the same past performance and only coming to you with a recommendation. He doesn't know the portfolio. He doesn't know the future of any portfolio. And they accept it. I can show you videos of influencers, I don't know how to study a portfolio. Then if you don't know how to study a portfolio, a current portfolio, what is the value of your comment about its future potential or your judgment?
See, one more thing is, the fund manager's job or the CIO's job is to keep on selling his fund. At no stage does he say, my fund is now not good. So he'll say, you don't worry, you don't time the market, I will do it. But the problem is, when these fund managers who are famous appear on media and say, this is the time to be putting in a BAF or in multi-asset, and you have to reduce your stake to equity. Believe me, there are so many types of BAF, so many types of multi-asset.
So many types of flexi cap also.
So many types of flexi cap. So if flexi cap fund, which is 70-80% in large cap, believe me, will outperform the index. There is no doubt
In
about it.
difficult times.
In difficult times.
But in bad times,
And see, if it's a very concentrated rally and the fund manager does not have those 4 or 5 stocks, which has happened in the US, it is the same.
so when you had that concentrated rally, you found that the PMS guy,
Who did not have 2 of them or 3 of them, he would have been taken to the cleaners.
no, the other way around.
Okay.
Who had
this would have obviously
So people from all that comes to the PMS guy to realize it will work later. So this process of taking short-term factors, trends, where the trend fits the manager and then extrapolating the short-term trend of the past into a long-term trend of the future is always going to lead to investment mistakes. And manufacturers will always project short-term trends when it is to their advantage. Everyone will do that, right? If I am a manager and I have got good 3-month performance, it's very tempting to say that I have done very well in the last 3 months or 6 months.
Yeah.
And then people take point to point to project conveniently.
Correct.
If you say it's not doing well, he will take the short-term performance, say last month it has done well. Or he may say look at 5-year, look at 10-year, look at since inception returns. So these judgments really don't help anyone make a better choice of a product. In my perception, it is the current portfolio that is the king.
Correct.
Past performance is only a minister.
I would put it this way. Past performance is an indicator as to how this will behave. For example, if there is Rahul Dravid, he will behave in a particular way. Yuvraj or Sehwag will behave in a particular way. In this match, how much they will score, we have no clue. In a match, Dravid could have a higher strike rate than Sehwag because he demanded, and Dravid has the talent to do it. So it reasonably gives you how he will perform given the circumstances, but it is not to say that every time he will score this much. And you have to look at standard deviation and things like that. And I don't think we could get carried away so much, because there are fund managers, very good fund managers, who don't perform for 3-4 months, 5 months. And then you look at the portfolio and say there's nothing wrong with the portfolio. So I know if I wait,
That's
I will
precisely where I wanted
That
to.
is important. That portfolio is what you will look at, and then if possible you will ask the fund manager, and the fund manager will tell you, should I buy a 70 PE stock or a 6 PE stock? That 6 PE stock will one day move up. That time I will make money. Then you realize his philosophy or her philosophy is right. It suits you. These are people who will not take high beta. Their funds are good for you. They will speak in a year or 2 or 3 years. It doesn't matter. You are running a marathon. You are not sprinting. So don't bother. Wait for the 42 kilometers.
On that note, I am going to close this video and take a break. We have a lot to discuss on mutual funds. A lot of interesting and contentious and at times controversial stuff. We are going to discuss everything threadbare in this series on mutual funds for Talking Straight with Subramanyam. Stay tuned.